Part 2, security analysis and portfolio management. So, in the introductory part, we understand what is meant by security. We can say what is the portfolio management. First, we understand the meaning of the subject, and then we understand what is investment, what is we can say the objectives of the investment, what is the journey of the investment, what is we can say the three different we can say the near to concept about the investment, that is investment, speculation and gambling. Okay, we take one example to understand what is investment and gambling. Okay, that is Warren Buffett and casino player. And now I think we understand also the steps in the investment process. Now the next topic is that is the investment in environment. Uh, what is the concept of the investment environment? Now that is we are going to understand that we are know that investment has the impact of the many factors. Like we can say the economical factor, political factor, social factors. Okay, some of we can say the regulatory factors also have the impact on the investments. So that's here we understand that investment don't exist in a vacuum. The first line that we, if you read that, the sentence is investment don't exist in a vacuum. That means you cannot make your investment in a vacuum. That means always your investment has impact on impact of certain factors. The factors like uh, economical, political, social, we can say the regulatory factors. Now we are going to understand what are those factors which have the impact on your investments. Okay. So in we can say the economical factor, we can say we can say the taste and preference of the customer, in which organizations you are going to invest. Okay, what are their production, what are their sales, what are their prices of the product, what are their competitors? All these are the economical factors. Okay, in we can say in political factors, the ideology which currently is in a government, is there we can say the political stability in the country or not. Okay, so these are some of the factors which have impact on your investment. Next one, we can say the some of the regulatory factors like the rules and regulations and the approval process in any country. That is, we can say the regulatory framework. Uh, if the ease of doing business in any country is, we can say, is good, the ease of doing business index is good. That means the environment for the business in that country is very well. So we can invest our hard-earned money, that is the monetary value we have. Definitely, we will get the great return on that investments. So these are the factors who we can say combinedly, we can say this is the environment around your investments, and that's why we called it as the investment environment. That means whenever you put your money in any instruments, we can say any investment avenue, you have to first analyze all these factors. Like first, you will have to analyze the environment around your investments. If the environment is good, then you can go with this investment. But if you find that these factors are not, we can say, find good, uh, that is the economical, political, regulatory, and social factors. If you did not find it well, then we can say stop your investment in that environment, because it may lose you in a futures. So we understand this, that is the investment environment factors. So now uh, here, if you find these some of the investment we can say investment environment factors are given. Uh, First one is that is the economic factors. First one is that is the GDP growth and the business cycle. If the GDP of the any country is we can say is good. For example, now India is we can say India's GDP is highest in the world, is near about 5.8, 5.7. And the other countries like America is the we can say very rich and the developed countries, but their GDPs or their growth, their progress is at only 1.7%. So that means the India's business is growing on a higher space. Okay, their space of development, we can say their acceleration is higher as compared to the other countries' businesses. So the India is, we can say, the best suitable market for the investment. That gives you the more return, uh, definitely more return, because we can say the scope of the business or the expansion is more in India. So next one, that is the business cycle. I think all you guys learn the business cycle in the subject, that is economic analysis for business decisions. Okay, so there are, we can say, the four main steps in the business cycle. Okay, whenever the we can say economy is in the boom, there is always the it is followed by the depression. Okay, that means whenever there is a boom in the economy, we can say the boom is not always present in the economy. It is followed by the we can say the recession and depression. Uh, so now currently, if you are making the investment, you can say as the student of the finance, as the student of the business, you must understand the economy is in which state is currently. I- Is it in a boom state, or is it is in the depression or the recession state? If the economy is in a boom stage, okay, so you will have the great return. But if the economy is in, we can say, is in the recession stage, or it may followed by the depression stage, okay, so you may lose your investment. So as the student of the finance, you must we can say analyze this business cycle accurately. Uh, if you fail to analyze it accurately, okay, you may have the losses in your investment. And now next one is we can say the inflation and the interest rates. Definitely, if the inflation is not uh, is in a control in any country, okay, in that condition, the investor may is in a danger. For example, if you I guys know the some of the economies like the Sri Lanka or some of the European economies. Uh, in these economies, the inflation rate is very high. We if you guys read the condition of the Sri Lanka last year, the inflation rate, that means the rate of the goods and services were very high. In that condition, what happened? We can say the economic collapse happened, followed by the higher inflation rate. In that conditions, the investment lost their investment because all the economic systems collapse, from the banking to the stock exchange and all these things. So in that conditions also the investors have the huge losses. So the investor first analyze the inflation condition currently is going on, in which country you are going to invest your amount, your money. Next one, that is the we can say the unemployment and the consumer spending. If the countries which are having the more unemployment rate, definitely their we can say their population, their people don't have the amount of money to spend on the goods and services, enough amount of money on the goods and services. As we all know, the we can say when demand for any goods and services creates, when the two conditions fulfill. Okay. Uh, what are these two conditions? That is, we can say the willingness to buy that product and ability to pay. Okay. So if the customers has the willingness to buy a product, but he don't have the enough cash, enough income, when he has the income, when a customer has a we can say the employment, then and then only if the customer is don't have we can say employment with him, so he don't have the enough cash to buy the product. If the sales of the goods and services is less in that country, definitely your investment not grow on the rate what you expect. So in that condition, the countries which are poor, which are having the high unemployment rate, and their consumer spending is not that much as we can say think of, then definitely you don't have the we can say growth in your investment what you expect from the investment. So these are the we can say economic factors which we must analyze before making the investment. These are factors of the investment environment. And next one is we can say the political and the regulatory framework. So these are the most important factors. As you guys see, if the government change, the investment pattern of the investor gets changes. Why so? Because the when the any government changes, ideology of the governments also gets changed. Because as we all know that the every political party has some ideology. It may be we can say some of the political parties of the conservative nature, some of the political party it may be of the free business minded. So whenever there is a political government change, the investors pattern change. If you guys analyze whenever there is elections happen in India about the April May of year after the every 5 years. Then if you see the pattern, okay, last time when the BJP government gets the less number of seats, okay, they came from the 300 3 MPs to 240 MPs. Okay, so now the BJP government is not in majority in the center. So that means they are not in a good position to take the firm business decisions. In that case, what happened? The investors, we can say, not invest their money. We can say with that much confident because they know the government is not in a position to take the firm decisions. Now the government always, we can say, is in the conditions of the loss of the majority. If the other parties, we can say, take their support, then definitely the government will collapse. So the investor wants the long-term confidence to get the returns. So the political and the regulatory these factors are also have the effect on the investor's mindset. Because whenever there is a change in government, they change the rules and regulations also. So these are the factors because we can say whenever the government change the tax regulations and all these things, we can say the trade agreements, so all these things gets changed. So according to that, the investors we can say have to think, and according to that, he has to made his investment decisions. Next one is that is the technological change. So investors whenever there is the we can say the change in the technology and the investors is not able to analyze the technological change, he may have the opportunity we can say lost to get the higher returns. Okay, so the technological change is the we can say the most important factors in the investment. Uh, as if we take the example of the Nokia company, we all know that Nokia is the well-known brand. before 15 or the 20 years. Okay. So when there is a technological change happen, the old fashioned mobile phone shifted to the smartphones, uh, and the operating system shifted to Android. But the Nokia go with the Microsoft, and the all other smartphone companies like the Samsungs, Realme's, we can say all these ways go with the Android. So the investors have the confidence with the Nokia because it is a very well-known brand. They invest with them, but the Nokia not go with the technological change. So what happened? We now we can say before the 20 or the 15 years, we can say the 9 out of the 10 customers have Nokia. Now we can say the 100 out of 1 customers have Nokia. Okay. In some of the cases, we could not find any customers. So, okay. So in that condition, the investors have the huge losses if the companies or the investor not predict the technological changes. Now, where the we can say the world moves, how the technological transformations happen, and which technological change the customer accept and which not. So this analysis must be accurate, and then only investors have the good returns in we can say for the longer period. Now next one is the global events. Now some of the global events also have the impact on the return and the investments. Okay, if there are we can say the conflicts between the nations is continuously happening. If we can say the some of the war situations you guys know on the international level, that is the Russia and Ukraine war, Pakistan and India conflict, India and China conflicts, Cambodia, and we can say so these conflicts, Russia, uh, uh, America and Iran conflicts, I think. So these are the conflicts which have the impact on the, we can say these are the geopolitical conflicts. If the conflicts are continuously going on, what happened? The situation in the nation is not friendly for the businesses because there are the war situations continuously bombing from we can say other sides are going on. So the business friendly environment is not present in that situation. So if we can say if you take as an investor in the wrong decisions and you put your money in such a nations, then what happened? You may have the losses in futures. So so we can say before investing your hard-earned money, you must have to analyze these we can say the geopolitical or the geographical conflicts, or we can say the war-like situation between the countries. If you find that it may be after the 5 or the 10 years, the war may happen. So a- avoid the investment in such a condition. Now, next one is we can say the natural disasters. Okay, we can say unfortunately, if you invest in any such a good stock or any good avenue, but unfortunately, any natural disasters happen like these tsunamis, we can say the earthquakes. In that conditions, also the investors will have the losses in the long run. Okay, so natural disaster is not in the anyone hands, but the we can say some of the countries like Japan, they continuously we can say they consistently having the tsunamis. So we can say the investors can avoid investment in such a areas where the continuously natural disasters are happen, so we can have the safe investments. Okay. Now, next one is the pandemic and the health crisis. We are know that the situations like a pandemic, like that is the COVID-19. In such a conditions, Uh, if you invest a huge amount of money, what will happen? You will have the losses in the, we can say, the long run. Because in pandemics, as we know, the all things are closed and the productions in the manufacturing plants are stuck. There is the no sales in the market, so there is if there is no sales, there is no revenue, no profit. The company is not making the profit. Definitely, company is not we can say growing at the good space. If the company is not growing, definitely you will have the bad returns on your investments. So all these we can say investment environment any investor must know. If we can say avoid or intentionally we can say not taken while doing the investments, definitely he will have the huge losses in the investment. But if he considers all these investment environment while doing the investment, definitely he will have the good returns, because all these investment environments have the impact on the businesses. So while doing any investment decision, first analyze all the factors of the investment environment. Now, next one is investment avenues. What are the different, we can say, options you guys have to invest your money to get the good returns? Okay, so what we call that investment avenues. That is, we can say the um, we can say you have to make the we can say portfolio. Okay, so we take each avenue from the each sectors and then we make the uh, portfolio. So we select the investment avenues or the investment options like we can say the equities, uh, like the fixed deposits, like the investment in gold, investment in cryptocurrency. All these options, all these avenues will have. But we select that avenues based upon the sum of the factors. That is, we can say the risk tolerance of the investors, how much risk he can able to take, what is the time horizon, in which time he wants the return on his investment. All these factors we consider, and then we select the best investment avenue. The investors have to select the best investment avenue so that he can fulfill the goals. As we in last session, we see the investment process. In that process, first we set the goals, what we want in the future, and accordingly that goal will plan. Accordingly, that goal, we select the different avenues of the investments to fulfill the goals. That goals, it may be what you want to buy, what you want, if you want to establish a business, so whatever it may be. Accordingly, that we can say calculate the risk. Okay, your risk may be of the two types. We can say the mental risk, and we can say the mental or the emotional risk or the financial risk. Yeah, if you are not that much emotionally strong, you, or we can say is not mentally strong. Okay, so you cannot in a position to take the huge risk. Okay, if you take the huge risk, then you may have the emotional damage. You may go into the depression. Uh, Even we can say you may have the situations like the heart attack. So first, investor have to analyze his emotional we can say emotional risk taking ability. Okay, if he is the we can say the emotionally fit, emotionally he is strong, then he can take the we can say more risk. In future, he may get the more return, but it we can say the risk must take on the based upon the emotional risk taking ability. Now, next one is we can say the financial risk. taking ability. If you don't have the enough fund, enough money with you, we can say we cannot take the we can say the more financial risk. If you are in a position to take the more financial risks, then the investors can take. So these are the factors on which, based upon this, we select the different investment avenues. So what are the different investment avenues that we are going to we understand all these avenues. So so we have the different options in which we can invest. So some of the we can say we have the traditional investment avenues, and we also have the modern and alternate we can say the modern investment avenue or the options that we are available. So what are the traditional investment avenues which are available? That is we can say from the long period of time the investor invest in such a type of avenues. These are the traditional investment avenues. That is first one is that is stocks and equities. That is we can say from the we can say 100 years the investor invest in the equities, that is in stocks. That is then what is mean by equities, what is mean by stocks? That is whenever the any businessman, any company, any organization wants the funds to expand its business, then what they do, they came up with the equities in the market. They come up with the shares into the market. That means they sells the some part of their ownership to the investors to raise the funds for the for we can say for the different purposes. For we can say to expand their business or to fulfill the requirement of the working capital. It may be so this sells their ownership to the investors in the company, and uh, those investors who buys the we can say shares or the equities of that organizations, uh, they'll get the two benefits. They get we can say the if the companies makes the profit, they'll get the dividend on their investments. Or if the valuations of the company, the wealth of the organizations gets increases automatically, their value of their shares also gets increases. So this is the one traditional investment avenue the investor has. Okay, now next one we can see the real estate. Real estate, that means whenever you buy the any physical property, okay, that we called it as the when for example if you buy the 1 bhk 2 bhk any we can say the vacant plot, then it is also a we can say the real estate property, because it is a physical property you can touch, feel. Okay, so that's why we called it that is the we can say the physical property. Or now some of we can say some advanced investment is available in the real estate, that is the REIT, that means real estate investment trust. That means the group of people came together, they put some we can say amount of money, they built the building, and from that building now they earn a rent. Okay, so if you invest in the RIIT, then you will get the rent of your investment. Okay. Now, how much you invest in RIIT at we can say for that investment, okay, you will get we can say the proportional rent on that investment. Okay. So this is the one of the options that is we can say the investor has, that is real estate. Now next one is the bonds. We can say the fixed income. Okay, so this is we can say this is a very traditional way of investment. Our parents or we can say the grandparents who don't know the we can say the modern investment. Okay, they we find many of the times at the homes also, that is they made the bank bonds. Okay, bonds for the 5 years, bonds for the 7 years. Okay, um, okay, the investor gets the double amount of the investment. Okay, these some of the examples we see at the homes, that is the In bonds, what we get, the regular interest and the return on the principals at the maturity. Okay, that means at the time of bond, their we can say interest rates and their maturity time, the both get decided, and at the end of the majority year, some lump sum amount will get to the investors. Okay, so this is we can say one of the investment avenues available to investors. Now, next one is cash and cash equivalents. We can say now some of the short-term government securities like the treasury bills, which are issued by the government whenever a government needs the fund for some developmental activities. Okay, to build the schools, to build the roads, okay, to build the government hospitals. That means the to implementation of the government policy. Uh, as we all know, the government announced the we can say some social activities in their annual budgets. Okay, if they have the fiscal deficit, that means the income of the government is less. Uh, okay, and their expenses are on a higher level. At the time, so what they did, they issue the treasury bills. Okay, so that means we put our money, we use the money to the government for the shorter period of time, and we can say they sells the treasury bills on a discounted rate, and at the end, at the maturity day, I'll get the we can say the face value of that we can say the security, that is the treasury bills. Okay, same likewise, if the companies require the funds for the shorter period of time to fulfill their working capital requirements. Okay, at that time, what companies do? They issue the commercial paper. So the investors can invest in the commercial paper. So uh, for we can say the shorter period of time, it starts from the 7 days to 364 days for the within a 1 year. So at the discounted value, the commercial paper issued to the investors, and after the maturity, they'll get the face value. So these are some cash and cash equivalent investments avenues also available to the investors. Those investors who are not capable to invest for longer period of time, who required we can say the cash and the liquidity at any time, we can say such a small investors who don't have the enough fund are goes with the cash and cash equivalents, because they we can say they require the liquidity or the cash we can any point of time. So these are the some dumb traditional investment avenues available to the investors. Now next one is, now we can say because of the technological advancement, what we find it out, there these are some modern we can say investment avenues available to the investors. Now uh, first one is that is mutual fund, and we can say ETFs, that is exchange traded funds. Now what is mean by mutual funds? uh, Mutual fund is we can say it is a type of fund who collects we can say funds or the money from all the investors who don't have the enough knowledge of the market, and then they have the financial experts, what we called as the portfolio managers, who invest all the collected amount into the different portfolios, into the different avenues, and and on that we can say the lump sum fund they collect, we can say they receive the return, and the return then gets distributed among the different investors. That means that that's what we call as the mutual funds. That means same like the single investor who invest in equities, who invest in insurance, okay, he invest in the different avenues like the gold, silvers, all these options the single investor have. Okay, so in the same way, the mutual fund, that is in a mutual fund manager or the portfolio manager invest same. same amount with the different avenues. But what is the difference? The single investor is not, we can say, expert in the finance, but the portfolio manager who is an expert in the in the financial management, who is expert in the market analysis, he who is expert in the economic analysis. So he accurately predicts the market. Accordingly, that he made the investments. So this is, we can say, one of the we can say the modern investment avenues available to the investor, that is the mutual fund or the exchange traded funds. Now next one is, that is the commodities, or if you guys heard, that is the, we can say, the derivatives market. That is the commodities. That means the physical goods like the gold, silver, oil, and the agricultural products, or the any of the we can say products value derived. We can say we can say this. We can say what is meant by derivatives first. We understand what is meant by derivatives first. So derivatives is a contract between the two parties. We can say who decides the value of this product. The product, like we can say the gold, silver, oil, or the agricultural product, that is the pre-decided, and they made the contract that on which price they settled the contract. Okay, so this is the we can say the derivative. That means the derivatives, in derivatives you can minimize the risk, or you can minimize the losses. So there are four types of, we can say, the derivative contract available to the investor. That is the future contracts, forward contracts, options contracts, and swaps contracts. So these are, we can say, the modern investment avenues. You can heard that some of the investors invest daily in futures and options. Okay, now these are, we can say, the modern investment avenues available to the investor. Now next one is the cryptocurrencies. So cryptocurrencies, as we know, the we can say, if the rupees is the one currency which have the approval from the Central Bank of India, that is Reserve Bank. Same likewise, dollar is the currency of US and has the approval of the Federal Reserve, that is the Central Bank of US. But the cryptocurrency, we can say, is a mutual understanding between the we can say the two parties who settle the payments. Uh, okay, so to, we can say, uh, to eliminate, we can say, the monopoly of the governments and the central banks. Okay, the some of the financial experts emerged with the cryptocurrency. Okay, so there are the many of the cryptocurrencies available in the market. So investors have other these options, that is the cryptocurrency. They can invest in the cryptocurrency also. Now, next one is the private equity. That means you can directly invest without intervention of any stock exchange, NSE or BSE, directly with the any business. That is the private equity. If you guys see the show, that is the Shark Tank. Okay, the one of the businessmen comes with the business idea. He presents his business idea to the sharks, and if the sharks find the business is well, his product, his customer base, and all these things are well, then the sharks invest the some amount into his business and get some equity. So this is, we can say, this is some private equities. That means when you invest the amount in a businesses without intervention of the NSE and BSE, that means the company is not listed on a stock exchanges yet. But if you find the business is good, then investors can invest his amount, his money into that business. Okay. So this is, we can say, recently the investors go with this investment. So this is also one of the investments options or the avenues available to the investors. And now next one, we can say the hedge funds. Uh, Hedge funds also is one option. What is meant by hedge funds? In hedge funds, actually, the we can say the risk of the loss is we can say the less. It is the same. We can say type of mutual funds fund where we can see the financial experts invest your amount into the uh, different avenues to get the return. But we can say these strategies are, we can say, a very strong and very active as compared to the mutual funds. Okay. Now next one is the collectibles. Now, uh, as we know, the some of the paintings, some of the art, like some of the diamonds, like we can say the Kohinoor diamonds. These are, we can say, the antique pieces which are we can say uniquely available into the world. So their value, we can say, is increases at very highest pace. Okay, if you collect these art, antiques, and rare coins, and we can say the mm, all these things, we can say collect with you as an investment, then you can sell all these antique pieces on a higher prices, and the investors gets the good return on it. So this is we can say in recent times, this is one of the investment options. We can say we can say investors find well. So this collectibles also the one of the modern investment avenues available to the investors. Okay. Now next one is we can say now as a investors we know now what are the traditional investment avenues available to the investors, and what are the modern investment avenues available to the investors. Okay, now the investor has some lump sum amount with his to invest this money. Okay, now the portfolio, we can say portfolio management, or the building we can say a good portfolio or diverse portfolio is very essential for any investment investors to reduce the losses or to get the we can say maximum return, or we can say the optimal return. Okay, so some of the factors has an impact on the investors decisions. If he considers these factors, then he can make the good diversified investment portfolio. Okay, so what are these factors? Now, first factor is that is the age, and we can say the life stage. Okay, so you all guys are near about 22 to 20, 23 years of old, or maybe up to the 25 years of old. If you guys start the investment, you guys have the enough time. That means you will have the 35 to 40 years uh, in front of you. That means you have the enough time. Okay, so you can take the calculated risks with you. But the investor starts at the age of 50, then he don't have the enough time. Okay, so we can say the younger investors can typically afford the more risks with the longer time horizon, because he has the enough time to take the risks. But the individual or the investors, we can say, lately he starts at the older ages. So he is not in a position to take the more risk. Okay. If he lost the funds, then he don't have the, we can say, the amount of money he wants in the old ages. So age and the life stage is we can say the very important factors while making the investment decisions. Now, next one is the risk tolerance. Okay, as I already told you, your psychological and financial ability, okay, to withstand with the market volatility. That means market volatility means we can say the market instability. Okay, so risks associated in the market. Okay, if you are psychology. psychologically, we can say, able, psychologically strong, then you can take the more risks. But if your heart is weak, you are not the psychologically that much emotionally or psychologically that much strong, then you always take the less risk to avoid the, we can say, the other circumstances like the mental depressions, like the other health issues, like the heart attacks and all these things. So risk tolerance factor must consider while doing any investment decisions. Now, next one is the financial goal. As we all know that investment starts with the set of the goals. Okay, any investment start, the investor first has to set the goals. So what he wants in a life. Okay, and in which time. Okay, in what times he want those things. Okay, when you want to buy the house, when you want to buy the Mercedes, when you want to buy we can say the any property, when you want to start a business, for that purposes what amount you required at what times. Okay, what amount you required after the 5 years, what amount you required for the 10 years, what amount you required for the 15 years, 20 years. So all these things must be considered while doing the investment. So what the financial goals, different objectives, okay, the investor sets. So accordingly, he has to make the different investment strategies. He have he has to select the different investment avenues from the, from we can say, from the traditional investment avenues. He need to select, and he need to select some modern investment avenues, and he has to analyze the risks associated with the different investment avenues. He has to, we can say, analyze the return, potential return uh, he may get on that we can say the investment avenues, and on that basis he has to take the we can say the different investment decisions. Okay. Now investing for the future. Okay, so these are the four most important, we can say, points while doing the investment for the future. You have to follow these 4 points. Now, that is, define the clear objective. Set the financial goals with the realistic timelines that align with your life plans. So, if I say, I told you that the investment process starts with the set of the financial, but your financial goal must be a real, we can say, not, we can say, the hypothetical. If you set any hypothetical goals which is not even we can say able to fulfill that financial goal, then we can say there is a no you, or we can say there is a no meaning of setting the financial goal. So financial goal should be realistic. That is, for example, if I take the example of the hypothetical financial goal, as we all know that the Elon Musk is the, we can say, the well-known scientist, the businessman that tells us that he is planning to, we can say, move to Mars. Okay, and he commercialized the Mars traveling to the people. If you set the goal that after 30 years I want any real estate property on a Mars, so it is, we can say, it is a hypothetical condition. It is not a realistic condition. Okay, it may happen, it may not happen. Uh, it may happen, then you can, but it is, we cannot, we can say now that it will definitely happen. Okay, so it is a hypothetical condition. So your goal must be a realistic. Okay, uh, then and then only we can say it is the achievable goal. Okay, so define the clear objectives, which are, we can say, realistic, and the, we can say, with the realistic timelines. Okay, so your timeline, and we can say the goals should be matched. That is the time horizon, and what you want should be we can say clearly defined, clearly specified. Now next one is, we can say, the understand the key differences. You, as a investors, you must understand the some of the differences. That is the, we can say, the investing, speculation, and the gambling. Yeah, I already told you that what is meant by investment, what is meant by speculation, and what is meant by gambling. So investment is the best option. Uh, uh, in investment, your money is, we can say, your hard-earned monetary value is safer at some level. So there is always risk associated with the investment also, but is more safer as compared to speculations and the gambling. So speculation is also, we can say, a good option when you are, we can say, the experienced investors. If you have the good market analysis ability, your experience is, we can say, a wide, and you know all the market conditions very well. Okay, you know the market momentum, where market goes, you know the price changes. Okay, so uh, if you are in conditions to analyze all these things, okay, so you can go with the speculations also, because in speculations you will have the good returns, because the speculators takes the advantage of the price movements in the two different markets, or he takes the price, we can say, he takes the we can say advantage of the price movement. For example, we can say, as you know, when there is the, we can say, the production season of anything, in that season, what we are know that the prices of that goods automatically less. But if you buy the goods in that, we can say, in that situation, and store for a longer period of time, when the demand is higher and the supply is less, okay, so you can sell your goods at that time and you will make the money. Okay, so the speculations is also good, but you, we can say, when you are is when you is in a position to do the good analysis, you know the market momentum, price momentums, and all these things, and then you can go with the speculations. So never goes with the gambling. So guys, because in gambling, we know that the output is not in the investor's hand and no one's hands. So, so never go with the gambling. Now, next one is follow discipline process. Okay, whenever you made the investments, follow the discipline process, which we can say we already see. That is the set of the goal, then analysis, then make a plan, then implement that plan, and then monitor and review. So this is the continuous process you have to follow with disciplines all this process, and then you will have the good results, good returns in the future. Now, next one is that is the align choices with the goals. Okay, the first, while starts the investment, we set the goals. So align your investments with the goals. Okay, what return, what amount of money you want at what time. Okay, if you do the alignment of the all, we can say, from the goals to the monitoring and review, if you follow all this process, okay, and you will align all the five processes, then only you will have, we can say, the amount you want in the future at what times. Okay, and then only you can fulfill your goals. So a smart investor must follow these four, we can say, the rules for the, we can say, investing for your futures. Okay, so anyone have any questions? So I think we sum up the sessions is already 6:57. If you have any questions, you can ask. Just I want to confirm that you guys listen the sessions, or you just attend the session. Some of the names I'll take and they'll have to confirm me. That is the Shruti Kamble is present, Adarsh Patil, Tejaswini Nirmal. Are you guys present in the session? Prajakta, you just have to unmute yourself and just said yes, sir. Are you guys present? Tejaswini Nirmal is there. Adarsh Patel, Ashwini Pawar. We are just confirmed that you just join the session or you're listening cautiously or not.
Yes, sir. Present.
Yes, who is this? Please tell your name, me just.
Ashwini Pawar.
Yes, yes, Ashwini. Now, Devanshu Chaudhary, Ayal Gidde, are you guys present in the session or not?
Yes, sir.
Mansi Kopde. Okay, so guys, please try to listen the full session very carefully because it's all we are doing for you. Okay, so please try to join very seriously and listen all the sessions very seriously. Okay, so we'll follow the practice that I will ask the questions onwards to the students to just confirm you are actively present or not. Okay, thank you guys. You can leave and you can join the other sessions. Thank you.